Lex, you talk a little bit about good liquidity for first-timers and, being in better shape. Can you talk a little bit about that?
Sure. Yeah. Just in general, to echo some of the points made, it's I think if you graphed what's happening in terms of credit availability, it's a nice downward sloping curve that feels like it's plateaued now. And so that concept of, is it easing? I think we're on the cusp of that. We'll kind of see over the next 3 to 6 months as the economy moves, but I feel like it's then going to be a very gradual slope up over the next few years in terms of in any sort of more aggressive lending, and hopefully never back to where things were 3-4 years ago, but we'll see. From our standpoint as a conventional lender, our process is not as involved as an SBA loan, and so while there's truth to the small deal kind of being a hassle factor, I think that we'll embrace that type of thing, but a lot of the other things that have been said apply too. Customers today, I mean, the bar has just been raised, and I think that a good chunk of folks who probably shouldn't have, but maybe they were growing too fast. I know in the past, you saw development agreements with pretty aggressive growth expectations, and I think that was just a function of the capital that was out there. And so I think that today it's harder to grow. If you just opened 2 stores in the last 18 months, we're going to look at that and say it's hard to measure what's there. Regardless of what concept you're in, it's hard to measure what's there. And there's just liquidity, or another word for it is margin for error. And I think that 4 years ago there was availability of capital where there was very little margin for error, and obviously there was pain felt for some of those folks when things declined. And I think today the key is, from our standpoint, we want to see some liquidity, some margin for error, because obviously it's a difficult environment to open a store. And there's stores that are opening that are doing extremely well, but it's, I just think you have less visibility or less confidence in any store that's going to get open in terms of how it's going to do in this environment. At least a lender's going to look at it that way. So, we want to see liquidity or a buffer zone or margin for error much more so than we did 3 or 4 years ago, just in case things don't open up like you think.
And that's a good takeaway, is for the franchisors, is their franchisees need more liquidity. They need to be taking a look at that with their franchisor.
In a nutshell, I think that's it.
Yeah.
Because of the changing nature of how capital is being accessed today, and we are more in a competition for credit, it is not being perceived that there is a lot of more credit. It has to be an adjustment that franchisors and franchisees make to the way the lending community is trying to evaluate, underwrite, and commit to loans. And because we're in that changing period right now, it creates a perception that things are as bad as they were last year. They're not as bad. Capital is out there. Banks have money. The challenge today is accessing it, and that's a competition issue. What makes that franchisee and what makes that system more attractive from a lending standpoint than any of the other loan options that a bank has in any week that they're considering making a loan? That's the difference that's happening now, and the perception that's created from that is that it's not any better. Well, it is better. It's just different, and we have to adjust the franchise mindset to what the lending community is asking for today.
This is Kevin from Dunkin. From what we're seeing, I don't think any of the underwriting standards have changed over the last year going into this year. But what we are seeing is more and more franchisees becoming healthier financially kind of over the last couple of years, deleveraging, paying off more debt. So those franchisees that last year may not have qualified will qualify this year under those those same underwriting terms.
Because they're starting to work at it.
Exactly.
It seems like that would have to be a franchisor-led, or something the franchisor could help their franchisees, investigate in their own business. What do they need to do to be financeable?
Keith from SunTrust, that was a great point about working on it, because what I see now is franchisors, it's no longer a hands-off approach to financing. Over the years, it's kind of, with my experience, kind of gone away from that. Here we got you signed up, try to go get financing, I think franchisors are really realizing that they do have to have a hands-on approach to it. To get to know, to actually interview the lenders and get to know the lenders to see what they can do. And if a lender truly wants franchise business, they'll work with you. But one of the things that the polling question doesn't ask is there's a big difference between lenders who are looking at startups as opposed to resales to remodels. I think every lender has probably tightened up on startups. But how are what's their access to financing with regard to resales, remodels, and then just the overall franchise relationship?
So it's a very broad question.
This is Laura from Wells. And along those lines, I think like with the startups, lenders have money to lend. I mean, again, we never stop lending in the financial position they used to be. They don't have equity in their homes like they used to. Their 401ks have diminished. They've lost jobs, so they've been using any savings that they did have. So their liquidity, available capital coming into a project is really limited where it wasn't before. And with those circumstances, their credit scores are getting hit. So that all impacts, the type of customers or borrowers that are coming our way as well.